Look at the dot plot now. There was a lot of discussion about the modification to the dot plot. Let's contrast the September and December dot plots. 4.6% was the final reading for September. However, 5.1% was chosen as the final dot plot value for December. In reality, the likelihood range for the market was 4.75 to 5% and 5% to 5.25%, but the later range was chosen. It was deemed to be terrible news by the market. Interest rates were predicted to decrease in 2024. It was fairly distributed in the preceding dot plot. However, a concentration was visible in this dot plot. In comparison to 2023, the interest rate is anticipated to decrease in 2024 from 4% to 4.25%. Additionally, if you look at the Fed's economic forecast, the 1.2% estimate for 2023 GDP has significantly decreased since September. It is anticipated that as the tightening posture increases to that point, the unemployment rate would increase and the economy will continue to suffer. Even in the cases of the unemployment rate, which was originally projected to be 4.4%, which has now increased to 4.6% in 2023, and inflation, which was also projected in September to be 2.8% in 2023 but has since shown a rise of roughly 0.3%. 4 key points from Powell's news presentation are as follows. It was generally hawkish. 1. I increased it by 50 BP, and it is sensible to do so going forward. Target price of up to 2%. 2. The labor market is robust. However, things will eventually get better. 3. CPI performed well, yet it is still insufficient. 4. Nobody is always aware of how the economy is changing. Examining the bond market now, when the dot plot resulted in being higher than anticipated, the market jumped briefly before falling as a result of predictions that the pace of inflation would slow down slightly more than anticipated and the potential for an economic recession. The 10-year Treasury yield started off at 3.4%, increased to almost 3.6%, and then decreased even further after the FOMC comments. To argue that the Fed is adopting a hawkish stance would be inaccurate. The likelihood of an economic recession is also deemed to be high. Rising recessionary fears were the cause of the stock market's collapse. It is wise to assess that. In fact, when the CM considered the idea of the base rate, the likelihood of a 25 BP increase in the baby step in February of the next year increased in comparison to the day before. The likelihood of a 50 BP spike has decreased. The final interest rate level will be in June of the following year, with a larger likelihood of 5% at 4.75 than previously. 5.0% to 5.25% is a lesser probability. It can be concluded from the market that there was a greater emphasis on the potential for an economic recession than on the Fed's tightening policy. Let's quickly review 2 crucial points. Signs that the Fed is tightening. 1. Data on the unemployment rate and prices, 23-day PCE price. 2. Economic indicators, China LPR rate on January 20th, and listed company performance, Micron on January 21st. Since the market is preoccupied with the recession, it's important to monitor the performance of publicly traded companies and determine if China's benchmark interest rate is accommodating. I wish to discuss my viewpoint. In fact, the inflation rate, CPI, could be determined before the FOMC. While it was announced, it was 0.2% lower than predicted at 7.1% when the forecast was 7.3%. But let's look more closely. The traffic fee is what caught people off guard about this CPI. Given that it makes up 10% of all consumer pricing in the US, this is a sizable item. Rates of consumer price inflation falling under this category. Although consumer price inflation rates in the transportation fare sector have consistently contributed to inflation, I believe that this unexpected fall provided financial market players with a welcome shock. Generally speaking, the rise in transportation costs lags behind energy prices. People have been moving more quickly than ever in the corona flow at this time, continuing to ascend as a result of this process before finally shifting back to a downward trend. is regarded as having stood due to these variables. The current U.S. consumer price inflation over the last 5 months has barely grown by 1% overall. This indicates that if things continue as they are, U.S. consumer price inflation will be in the low 2% area in around another 6 months or so. In the end, it is clear that players in the financial market made wise decisions given the likelihood that the current consumer price inflation rate of 7.1% will decline significantly. Now let's go back. 2 crucial things. 1. Unemployment rate. 2. China LPR rate decision and listed company performance announcement. The unemployment rate hasn't been reporting as well as the Fed would like. The high rate of salary growth is one factor contributing to the high CPI growth rate. There was a lot of turnover as the wage increase rate increased, which encouraged businesses to pay higher wages as soon as possible and force the employment rate up. The Fed increased interest rates and tightened monetary policy to severely curb the spiraling inflation that resulted from this vicious cycle. But how about right now? Let's look at the wage increase rate. Of course, the rate of increase is not as stable as before, but it does not show the rate of increase as much as 2021 to 2022. This means that the market where workers come first is coming to an end. In other words, the unemployment rate is bound to rise. By the way, now you probably think that if the unemployment rate goes up, we will lower the interest rate now, so the stock price will go up. That is a serious error. Due to? The performance of businesses will decline as the unemployment rate rises. A recession will inevitably occur if corporate performance is poor because GDP will decrease and spending will slow down. Any chance to verify this? Specifically, the results of listed firms. Stock prices will soar if listed companies post higher than anticipated earnings since the likelihood of a recession is diminished and rising unemployment is ignored. The performance of listed firms and the anticipated unemployment rate data must therefore be carefully examined by this FOMC. After completing the FOMC analysis above, we discussed 2 critical future factors. We appreciate you taking the time to watch the J&J stock story video. Next time, I'll bring a better video.